Hi there everyone and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances and you need to decide for yourself what is appropriate to you. Okay, so the market decided to pull back a little bit through the second half of the session to close slightly lower at 74.34. Once again, we've come up to test this 74.70 level and have not been able to push through. So that's about the fifth attempt now. We keep failing at this level. But nonetheless, the trend is up ever so slightly. But to sideways really. Okay, so we've got a bit of a sideways phase here since the about middle to end of October. We haven't really been able to break out of either the bottom of 73 or the top of 74.70. So only time's going to tell where we break. With the trend being up, we would expect a break to the upside at some point soon. But nonetheless, just a bit sideways for our market at the moment. It's very different to what we're seeing over in the US markets though, where they have shot up quite strongly over the last month. So continuous all-time highs. Okay, 4,700 seems to be the top of their market for the moment. We can see a couple of days in a row of dojis there. We've got weak futures, so it looks like they're ready to see a bit of profit taking. So I would not be surprised to see a few days of pulling back coming into the US. In particular, the US will be focused on their inflation readings coming out on Thursday. So I'd say one of the bigger reasons why our markets held back is we've come into a bit of a banking reporting period where we see ANZ, Westpac, NAB and Macquarie all report. It's typical to see the banks pull back around their dividends, okay, which is what we're in the middle of right now. So we're seeing a little bit of weakness in the banks. Miners are struggling to push higher with the volatility around iron ore and a little bit of volatility we've seen in metals over the last month. So with our two major sectors holding back a little bit here, it's really that's why we're struggling to follow the US on the way up here. But all in all, here and overseas, things are fairly positive. Economies are reopening. We're going to start seeing travel back into Australia again. As we approach these 90% vaccination levels in Victoria and New South Wales, a lot more freedoms will be seen. The other states are a little bit behind on the vaccinations, but we will see, I believe, travel throughout Australia pretty quickly towards middle to end of December, outside of maybe WA, okay, which is indicating they probably won't reopen until about February next year. So look, there's freedom of travel coming back. Tourism will come back into Australia coming in over the next sort of 3 to 6 months. We're going to start seeing students back here, immigration back up again. So all that sort of reopening is quite positive for the economy at the moment. And I guess the market should continue slowly climbing on the back of that coming into next year. The other big thing that helped markets rise recently has been Biden's infrastructure spending, which was approved Friday afternoon. And we're seeing a bit of reaction onto markets coming last night and today. So a bit of positivity there, although the reaction we're seeing at the moment is perhaps maybe a bit of a buy the rumor, sell the fact, in that some of our industrial stocks have actually pulled back a bit after a strong move higher. Okay, so still very positive, guys. We might not have had the positive reaction now. A lot of it's probably priced or somewhat priced in. We're seeing a bit of profit taking coming into the markets now, but the backdrop is still positive. Okay, the question is, can he get the social part of his spending agenda going? Right, that's what we're looking for right now. So the industrial spending positive. We should see strength in the miners stay. I should say strength in the metals, okay, and industrial metals, that sort of thing. We should see that stick around for a while. China's a little bit of an issue with that as well. They're stopping the metals from rising a lot, because every time they do, they come out and they're controlling the sentiment around that at the moment. So every time metals go up a lot or iron ore goes up a lot, you see a bit of an announcement from China saying that they're going to crack down on futures traders and things like that. So it's sort of a bit of a seesaw. Nonetheless, most industrial metals are sitting near all-time highs, which is extremely positive for the material stocks, the miners in the US, the miners here locally as well. So nonetheless, from a long-term perspective, this is all pretty positive news. The next thing really is to sort of keep an eye on is the central banks. We saw the RBA and the Fed report last week. Basically, at this stage, we know the Fed's tapering at a rate of 10 billion in treasuries and 5 billion less in mortgage-backed securities each month. So you can see that they're slowly going to be pulling this back. And whether they keep going at that rate or not will really be determined by the economic strength. So they're not married to any of this, okay? So they're basically tapering at 15 billion each month, okay? But they are currently buying 120 billion. So, it's still going to take a while to get to a point where they've tapered down to nothing, right? Now, furthermore, and this is the important part here, is there's a lot of people speculating that interest rates are going to go up quickly after they stop tapering bond buying, where the central banks are actually saying something different. They're saying no, once we stop tapering, it doesn't mean interest rates will go up straight away. So some banks and some people have come out predicting rate rises for next year. Some have come out saying 2023. For me, I actually think it won't be until maybe 2024 that we'll see rate rise out of the RBA. The RBA has been very, very clear in saying that they're looking for wage increases. Okay, so they want to start seeing people's salaries go up, which is very, very important. Okay, only reason why we're seeing economic strength at the moment is because we're in the middle of a rebound from what happened because of COVID. So things look good on the surface, and things will continue to look that way over the next year or so. But then, things will likely go straight back to what they were before COVID, which was we had deflationary problems, we had issues with seeing increased wages. So the cost of living continues to go up, but wages don't. So all those issues are still going to be there. And that's what we want to see improved before we're going to be able to even increase interest rates. Because if central banks increase interest rates now, they're going to cause a pretty big downturn because a lot of people are indebted a bit too much than what they should be. Right? And I think the central banks are aware of this, and that's why now we're leaning on things like bond buying, QE type measures rather than hiking interest rates, which will really not have the desired effect overall. Now, look, the next big test for the US market, outside of the inflation reading this week, will be the debt ceiling issues, which they pushed out to early December. So effectively, they've got 3 weeks to resolve this problem. Let's just see what happens there. They push this debt ceiling out again. Hopefully, they can have a full 12-month spending plan that gets rid of this problem altogether. So, let's see how that plays out for the rest of the month. But nonetheless, guys, look, the market, the US market, the S&P 500 is hitting that overbought sort of target for me at the moment. So there could be another couple of % higher in it, don't get me wrong, but it is looking a bit overbought. What that means, it doesn't mean I think we're going to go into a downtrend. It doesn't mean that I think we're going to go for a 10% correction. What it means is it's due for a bit of a pullback. And because there's a buy the dip mentality over there, it's likely to be a short-term pullback, maybe a couple of days, maybe a week, all right? But nonetheless, they're due for a pullback, guys, okay? And it's typical to the seasonal pattern. They're coming towards the end of their reporting season. You tend to, some point in November, pull back and then rally again in December going into that Christmas period, okay? So the exact timing of that changes each year, all right? But at some point, the market's overheated over there, pullback is due, then that will set you up for a nice big Christmas rally. All right, so that's kind of the general feel at the moment. Most things for me are very positive. I think the tapering for the bond buying is very, very positive. They're saying that there's a general view out there that the economies can start to slowly stand on their own 2 feet once again and not need, and the credit markets won't need that bond buying support that they're getting. So they can slowly unwind that and let things just stand back on their own 2 feet again. That's all positive, guys. It's not a negative thing. Even interest rates going up can be a positive thing if the economic data shows that the economy can handle it. So what we want to see, and what's really, really important for markets over the next 12 months, is that the economic data that we see matches in with what the central banks are doing. If we start seeing a downturn in economic data and they want to increase interest rates, well, that's going to be a big problem for the market. But if the economic data is showing a lot of strength and they go to increase interest rates, then that also could be a positive thing. Okay, so things aren't always, black or white with these types of things, right? But what the simple thing you need to look at is economic data strong, and is that matching what the central banks are doing? If there's a mismatch, then the markets get a bit nervous. All right, so that's where we're at, guys. Okay, thanks for listening in. Take care, and bye for now.